On June 18, 2020, the chief executive officer of Germany's most celebrated technology company sent a simple message to his employees. He was stepping down immediately. Within hours, trading in Wirecard shares was suspended. By the end of the week, this former darling of the German stock market had filed for insolvency, leaving behind debts of nearly €4 billion and a gaping hole where $2.1 billion in cash was supposed to be. The money had never existed. For over a decade, one of Europe's most sophisticated payment processing companies had been running an elaborate fraud that fooled investors, regulators, and some of the world's most prestigious auditing firms. The collapse sent shockwaves through Germany's financial system and exposed fundamental weaknesses in corporate oversight that allowed a company to fabricate nearly half of its reported revenue for years. This wasn't just another corporate scandal. This was a complete breakdown of the checks and balances that are supposed to protect investors and maintain trust in financial markets. The chief executive officer didn't just resign that June morning. He disappeared entirely, fleeing the country as prosecutors prepared fraud charges that would eventually lead to his arrest. Meanwhile, thousands of employees who had believed they were building the future of digital payments suddenly found themselves unemployed, their stock options worthless, their pensions evaporated. The Wirecard fraud wasn't just about fake accounting entries or inflated revenue numbers. It was about how a company could systematically deceive everyone from small retail investors to institutional fund managers, from German regulators to international auditors, creating a house of cards that reached €24 billion in market value at its peak before crashing to zero in a matter of days. Wirecard's rise began modestly in 1999 when it started as a simple payment processor for online gambling and adult entertainment websites. By 2008, the company had expanded into mainstream e-commerce and went public on the Frankfurt Stock Exchange with a market capitalization of just over €1 billion. The timing was perfect. As European consumers increasingly embraced online shopping and mobile payments, Wirecard positioned itself as the bridge between traditional banking and the digital future. Revenue growth was extraordinary, climbing from €391 million in 2014 to €2.8 billion in 2019. The company's stock price reflected this meteoric rise, increasing by more than 1,500% between 2012 and 2018. By 2018, Wirecard had become the first German financial technology company to be included in the prestigious DAX 30 index, replacing the traditional bank Commerzbank and symbolizing Germany's digital transformation. International expansion was equally impressive, with operations spanning across Asia, North America, and throughout Europe. The company processed payments for major retailers, airlines, and digital platforms, handling billions of transactions annually. Revenue from Asia-Pacific operations alone was reported to exceed €1 billion by 2019, representing more than a third of total company revenue. Major investors took notice, with prominent fund managers publicly praising the company's innovative approach to digital payments. The chief executive officer became a regular fixture at technology conferences, presenting Wirecard as Germany's answer to Silicon Valley payment giants. Partnerships with major financial institutions and technology companies seemed to validate the company's business model, while consistent double-digit revenue growth quarter after quarter impressed analysts and investors alike. By early 2020, Wirecard's market capitalization had reached €24 billion, making it more valuable than Deutsche Bank, Germany's largest traditional lender. The first cracks in Wirecard's facade appeared in February 2019 when the Financial Times published a series of investigative articles questioning the company's accounting practices in its Singapore operations. The newspaper alleged that senior executives in Asia had used forged contracts and fake transactions to artificially inflate revenue and profits. Wirecard vehemently denied these allegations, with the chief executive officer personally attacking the Financial Times reporters and suggesting the articles were part of a coordinated short-selling campaign designed to manipulate the stock price. German financial regulators, rather than investigating Wirecard more closely, actually banned short selling of the company's shares for 2 months, citing concerns about market manipulation. This regulatory response seemed to vindicate Wirecard's position, and the stock price recovered quickly. However, behind the scenes, the allegations had triggered more scrutiny from auditors and investors who began asking increasingly difficult questions about the company's operations in Asia. The company's external auditor, Ernst & Young, had been raising internal concerns about Wirecard's accounting practices for several years, but had continued to sign off on the annual financial statements. In early 2020, as the auditing process for the 2019 annual report began, Ernst & Young demanded direct confirmation of cash balances held at partner banks in Asia. For months, Wirecard provided documentation that appeared to verify the existence of $2.1 billion in cash held at banks in the Philippines and Singapore. These cash balances were crucial to the company's financial health, representing nearly a quarter of its total reported assets. However, when Ernst & Young finally contacted the banks directly, they received a shocking response. The banks confirmed that the accounts existed, but contained virtually no money. The supposed $2.1 billion in cash was nothing more than fabricated bank statements and forged documents. The revelation that Wirecard's cash didn't exist triggered an immediate and catastrophic collapse. On June 18, 2020, Ernst & Young refused to sign the company's annual audit, publicly stating that they could not verify the existence of $2.1 billion in cash balances. The stock price plummeted by 62% in a single day. Trading was suspended the following morning as investors desperately tried to understand how such a large sum of money could simply not exist. Within days, major creditors began demanding immediate repayment of loans, triggering a liquidity crisis that made bankruptcy inevitable. The chief executive officer initially blamed rogue employees and suggested the missing money had been stolen, but as investigators dug deeper, it became clear that the fraud was systematic and had been ongoing for years. On June 22, he was arrested at his home near Munich on charges of fraud, breach of trust, and market manipulation. The chief operating officer fled Germany entirely, eventually being arrested months later in Russia while attempting to board a flight to an undisclosed destination. As the full scope of the fraud emerged, it became apparent that Wirecard had been fabricating not just cash balances, but entire business relationships and revenue streams, particularly in Asia. Employees who had worked for the company for years suddenly realized that major partnerships they had believed were real were actually fictional. The human cost was devastating, with over 5,000 employees losing their jobs as the company entered insolvency proceedings. Investors, including major pension funds and retail shareholders, lost billions of euros. Some investors had borrowed money to buy Wirecard shares, believing they were investing in Germany's most promising technology company, only to find themselves facing financial ruin when the stock became worthless overnight. The Wirecard scandal represents more than just corporate fraud. It exposed fundamental weaknesses in the global financial system's ability to detect and prevent sophisticated accounting manipulation. For over a decade, prestigious auditing firms, regulatory agencies, and investment analysts failed to uncover a fraud that involved fabricating billions of dollars in revenue and assets. This failure raises disturbing questions about the effectiveness of corporate oversight and the reliability of financial reporting in an increasingly complex global economy. The scandal also highlighted the dangerous intersection of national pride and financial regulation, as German authorities initially chose to protect what they saw as a national technology champion rather than investigate credible allegations of fraud. The decision to ban short selling rather than increase regulatory scrutiny sent a chilling message about the politicization of financial oversight. Perhaps most troubling, the Wirecard fraud demonstrated how quickly trust, once broken, can destroy even the largest companies. In just 4 days, a company worth 24 billion euros became worthless, not because its underlying technology was flawed, but because its entire business model was built on lies. The ripple effects extended far beyond Germany, shaking confidence in European financial markets and prompting regulatory reforms across multiple countries. For investors, the Wirecard collapse serves as a stark reminder that due diligence cannot be outsourced entirely to auditors and regulators. The most sophisticated financial statements and the most prestigious endorsements mean nothing if the underlying business is fraudulent. In our interconnected global economy, where billions of dollars can be transferred instantly across continents, the Wirecard scandal proves that old-fashioned skepticism and rigorous verification remain our best defenses against financial deception. The $2.1 billion that never existed serves as an expensive lesson in the eternal truth that in finance, if something seems too good to be true, it probably is.